Our team analyzed 90 Days, which is the person-to-person finance platform company. It is operated by Cross, 한국어음중개. 90 Days provides an electronic bill-based loan platform for SMEs, the borrowers. This service system can help SMEs because they are difficult to receive direct fund reinvestment from banks because of their small size and low credit. If a borrower requests loan in the platform, 90 Days analyzes a borrower's risk using loan issuing banks guidelines. Then when the requirement is approved, 90 Days lists it on the platform to source funds from investors. 90 Days facilitates the entire process of borrowing, loan repayment, and disbursement in exchange for a fee. In detail, the cores in 90 Days FinTech are electronic bill and the objective internal credit system. SMEs request a loan using their electronic bill, and in the loan process, 90 Days analyzes SMEs' credits by their internal system, which was developed jointly with NICE rating. And then 90 Days give SMEs their electronic bill discount rates so that investors can quickly get objective information.
P2P lending can indeed be such a benevolent midpoint between by offering adequate interest rate or profit rate for lenders and borrowers, bridging the gap between banking sectors and loan sharks. On contrary, it is also true that P2P finance has a higher delinquency rate compared to conventional business, and some investors are suffering from losses due to exaggerated or often false advertisements. 90 Days enable investors to overcome the overconfidence myths in two different ways, providing adequate financial information and encouraging an automatic portfolio system. Firstly, 90 Days provide financial information that aids investors to make a reasonable judgment. An electronic bill is account receivables of small and medium-sized enterprises. For profitable investment, it is essential to understand the specific enterprise and properly guess whether the enterprise will pay back. For further understanding, 90 Days offer financial information of bill issuer and billed for the last 3 years based on its financial report. With this information, investors can avoid foolish mistakes.
Secondly, 90 Days offer an automatic portfolio system that prevents investors from putting all their eggs in one basket. As we all know, diversifying portfolios can reduce unsystematic risk and increase profit rates on a relative scale. Most of the electronic bill lending lasts no longer than 2 or 3 days, which can make investors impatient. To prevent those to make a hasty judgment, 90 Days offer an automatic investment system. If investors preset the length of maturity and profit rate, the system invests by itself. In this way, investors cannot invest over 100,000 won on specific electronic bills. If someone wants to invest a million won through 90 days, he or she would get a diversified portfolio with at least 10 assets, and it would be safer.
Not only because P2P finance correcting those behavior anomalies, but also because it provides reasonable interest rates for both borrowers and investors by allowing transactions only through online system, P2P finance has been called innovative financing. The accumulated P2P loans in Korea amount to more than 11 trillion won, and more than 200 P2P platforms are existed in Korea. Also, the world's first P2P finance law has been in effect since August 2020 in Korea. It means P2P finance will be incorporated into the formal finance system. However, the problem is that P2P platforms' delinquency rate has been on rise recently, and some investors make a blind investment due to lack of borrowers' information. Therefore, it is expected that the platforms which provide more accurate analysis of borrowers and manage its delinquency rates effectively, like 90 Days, will get the competitiveness in the future. Thanks for listening.